Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. This show is going to give you the basic primer to investing in mutual funds because we've got some very simple but powerful concepts to talk about. Let's start with the first one that we're dealing with today, and that has to do with value averaging and the advantage of using systematic investment plans. We'll take some numbers and we'll take you through the most important aspect of this powerful tool. The second one is continuing your SIPs for the long term. There is a very magical thing that comes into play after the first 10 years of investing through an SIP. Again, we'll take you through a very interesting illustration. The third point, a lot of people are investing in sectoral and thematic funds, but we're talking about the questions that you should be asking before you choose to invest in one of these schemes. New fund offers, very interesting, very glitzy, very glamorous, a lot of marketing that gets into these. But there is no cost advantage to investing in a new fund offer, and we'll tell you why. We'll also talk about why you should look at the balanced advantage fund of a mutual fund scheme that is launching a new fund offer in the equity space, because that is going to tell you whether or not you should place your money in their new scheme. To talk about all of this, I'm joined by Vijay Mantri. Vijay, thanks so much for taking the time, as always. And let's start with the first concept, because it's a very powerful concept. What is this value averaging concept when it comes to SIPs?
So it is the very simple concept called Rupee cost averaging. And in the business of investing, simplicity prevails over complexity. But many people think that simplicity lacks profoundness, and by following a simple investment strategy, we may be missing out of something very, very big. But through today's show, we are going to prove that a simple strategy can be really profound, can create lots of wealth for the investor. So let's look at what does a smart investor or very evolved investor attempt to do. He or she attempt to buy market at lower and lower level because they believe that they are much better at timing the market, and perhaps they can buy the market or any other asset at the valuation or at the value lower than the normal people can do. But can a normal investor, a normal person can do the same thing? Our answer is yes, emphatic yes, that it can be done. And we can explain through in today's show through a simple concept called Rupee cost averaging.
Take that advantage. Vijay, you've sent me one fund, and this is, of course, not recent data. It's actually just a little bit dated, but it's still relevant for the purposes of this illustration. We've looked at the HDFC FlexiCap fund, and we've looked at 5-year period, 10-year period, 15-year period, and we've gone all the way up to a 29-year period. And we've talked about how there is a divergence in the average NAV for the month and the average NAV of the SIP that you would do, or the systematic investment plan. Can you explain the numbers that are contained in this table?
So for instance, if you look at, let's look at this fund got launched on 1st January 1995 at 10 rupees NAV. And today the fund's NAV is 1812 rupees. That is on 1st July 2024. And if you see the screen in front of you, 5 years back, that is 1st July 2019, the NAV of the fund was 700 rupees. If I take 1st July 2019 as the beginning and take NAV of every month, so from 1st July 2019 till July 2024, we got 60 months. So starting NAV is 700 rupees, and on 1st July 2024, NAV is 1812 rupees. So if I take 60 months average, the average of 60 months is 971 rupees. Similarly, if we took average for 10 years, the average NAV is 752 rupees. And if you look at average for 15 years, the average for 15 years is 590, average for 20 years is 473, average for 25 years is 384, and average for almost 30 years is 327 rupees. Now, if you look at your screen, which is right now in front of you, 5-year average NAV is 971 rupees. But if you during those same 60 months, suppose you did SIP, then the average price for you, the average NAV falls from 971 to 864. So average arithmetic average for 60 months is 971. But in same 60 months, if somebody did SIP of 60 months, their average cost come down to 864. So the gap between average NAV and the SIP average cost is 11% for 5 years. Suppose you look at data for 10 years, the gap between arithmetic average and SIP cost come to 14%. And if you look at 15-year period, the gap between arithmetic average of 180 month, which is 590 rupees, and SIP cost come to 433 rupees. So you bought market at 27% discount. Suppose you did 15-year SIP in this fund. And if you look at data for 20 years, then 20 years average SIP cost is actually 473 rupees, but SIP cost come to 243 rupees. The difference between arithmetic average and SIP average cost is 49% for a 20-year period. And if you look at data for 25-year period, average arithmetic cost for 25 years means 30-month, the average cost is 384. But if you did SIP of 10,000 rupees or any fixed amount for those 300 months, then your average cost come down to 64 rupees. So the gap is 83%. And if you look at HDFC Flexi Cap Fund, is starting NAV 10 rupees. 1st July 2014, 24, the NAV is 1812 rupees. The average of these 354 months is 327 rupees. But if somebody did SIP in HDFC Flexi Cap of fixed amount for these 354 months, then the cost come down from 327 to 33 rupees. So if anybody who has done SIP in HDFC Flexi Cap since its inception of the fixed amount, then the average cost for the SIP for that investor is 33 rupees. And today the fund's NAV on 1st July 2024 is 1800 rupees. So this is the power of rupee cost averaging.
So just to drive home that point, Vijay, ultimately it is the systematic nature of this to say that if you are doing an investment of 10,000 rupees, a fixed amount every month, because you have the fluctuation in the NAV based on where the market is going, in some months you will acquire more units, in some months you will acquire less units. But because the NAV falls dramatically with the market, in some months you will accumulate a very large number and you will average your cost. Is that the correct interpretation?
Yeah, that's very true. And when we say in some month we acquire more unit and some month we'll acquire less unit, we'll acquire more units when the prices are low and we acquire less unit when the prices are high. So let me explain through two very simple illustration that will make more sense to investor. Suppose an investor would like to buy one share of a particular company every month. So if the company's share price is 200 rupees, they invest 200 rupees. If price is 500 rupees, they invest 500 rupees. Is 1,000 rupees, 2,000 rupees, 4,000 rupees, whatever is the price, they invest that much amount. But instead of doing that, if the same investor said, instead of buying a fixed quantity, I will buy fixed amount. So they say, for instance, one company share, they would like to buy 2,000 rupees per month. So when the price is up 200 rupees, you invest 2,000 rupees. So you end up buying 10 shares as 200 rupees. But instead of that, suppose you bought only one share, then you only end up investing 200 rupees. Other illustration, which is much easier to understand for many investors, is take the illustration of gold. For instance, in last 20 years, on every Dhanteras, if somebody bought 10 gram of gold, so for 200 years, for 20 years, they end up buying 200 gram gold. And suppose the average cost come to, I did this number few years back, the average cost come to 19,000 rupees. So you invested 19,000 rupees per year, you invested 3,80,000 rupees and you got 200 gram gold and your average cost came to 19,000 rupees. But instead of buying a fixed quantity, if the investor has bought 19,000 rupees of gold every year, then instead of 200 gram, he or she end up owning 380 grams. Why this happened? Because when they bought fixed quantity, When the prices was 4,000 rupees, they only invested 4,000 rupees. But when you buy a fixed amount, say 19,000 in this case, when the prices was 4,000, you invested 19,000 rupees. So instead of 10 gram, you end up acquiring almost 50 gram. So your average cost come down. So in any asset category, which is little volatile, buying fixed amount will always bring your cost down rather than buying fixed quantity.
So that's a very powerful concept. The second concept that we should talk about is the power of compounding, which comes through, especially when you're using the SIP route. And the longer you hold it, the better it is. And this is also an illustration that you shared with me. It is something that starts with an investment or an SIP that you take through for the next 20 years. Now, take me through some of these figures here. You're talking about a 5,000 rupee SIP. So in the first year, you've invested about 60,000 rupees. The gain is 4,773 rupees. So in your illustration, in the first year, Vijay, you're talking about a gain of 7% with an internal rate of return, XIRR, of 15%. And for those people that are not familiar with XIRR, you're talking about the fact that in the first month, you're only putting 5,000 rupees. You may not get a 15% on the entire portfolio, right? So even if something is given you on a blended basis over the course of that investment, over that 12 months, it's given you 15% IRR. You've ended up with a gain of about 7% on the principal investment that you've made. But Vijay, over the course of several years after that, particularly after the 10th year, there's a very magical shift that happens, right?
So you're absolutely right. When we say X IRR, the meaning of, suppose you did 12-month SIP, then first tranche earn you 15% for 12 months, the second tranche for 11 months, third for 10th month, and the last for 1 month only. So we call it X IRR. And that's why, so suppose you did SIP for 1 year of 5,000 rupees per month, you invested 60,000 rupees. For a 3 year, you invested 1,80,000 rupees. For 5 years, you invested 3 lakh rupees. And for 7 years, you invested 4,20,000 rupees. Now at the 15% X IRR, after 1 year, your portfolio has gone up from 60,000 to 64,000. 60,000 is your cost. 64,773 is your portfolio value. In this portfolio value, 60,000 rupees your principal amount and 4,773 is the gain amount. So gain as a percentage of your total portfolio after 1 year is just 7%. If you look at 3 years, at the end of 3 years, you invested 1,80,000. The portfolio value is more than 2,24,000 rupees. The gap is 44,000 rupees. That is gain. And now that gain is 20% of total portfolio value of 2,24,000. At the end of 5th year, you invested 3 lakh rupees. The value of the portfolio is 4,23,000. So gain is 1 lakh, portfolio value is 4,36,000. The gain is 1,36,000. Now this 1,36,000 is 31% of 4,36,000. And if you look at 7-year period, you invested 4,20,000. The value of the portfolio is 7,17,000 approximately. The gain is 2,96,000 rupees. And the gain now represent 41% of your total portfolio. That is the number you are seeing on your screen. But suppose you go for a 10, 15, 20th year, then what we see, the gain component. So here, just look at this slide. If you look at this slide, at the end of 10 years, the gain is 54%, principal is 46%. At the end of 15th year, the gain is 71%, principal is 29 year. And if you look at end of 20th year, the gain is now 82% of the total portfolio value and principal is only 18%. But this gain amount remain only 7% for 1 year, 20% for 3 years, for 31% for 5 years, and 41% for a 7-year period. But beyond 7 years, the gain become bigger and bigger component of your total portfolio. So after 10 years, gain is more than 50%, 54% at the 10th year, 15th year has become 71%, 20th year is become 82%, and 25th year, it actually become 89%. So this slide, again, you see the The yellow part is your principal and the red part or the pink part is your gain. In 1 year, 93:7 ratio. 3 year, 80% principal, 20% gain. Third year, 69% principal amount, 31% is the gain amount. Seventh year, 59% is the principal amount, 41% is the gain amount. Moment you cross 15-year plus, the gain become higher and higher. Suppose you look at 10-year period, if you look at 20-year period,
Yeah.
in 20-year period, gain become 82% of the portfolio. So this is the magic of SIP where the longer you go, you allow power of compounding to kick in. And because of power of compounding, money invested, interest create interest, the gain create gain for you, further gain for
Yeah.
you. That's why the component of gain increases in the portfolio.
Your money starts working for you, which is a very powerful concept, and it is the core principle of compounding as well. Let's talk about another aspect, and this is the third topic that I wanted to take with you, Vijay, which has to do with the interest, the retail interest in thematic and sectoral funds. And there's quite a bit of that. It's now the largest category in the actively managed space. But let's talk about what you should ask before you invest in some of these, because ultimately what sometimes happens, or actually I should say more often than not happens, if you put money in certain sectoral schemes, what happens is that a large chunk of your money gets locked in just a few stocks. We're talking about 2 or 3 stocks that account for 20+%, 30% of the portfolio. So there is no advantage to that. Sometimes, of course, you can have outsized returns, but more often than not, there is a concentration risk and you can lose. So therefore, what questions should you ask before you invest in a sectoral or thematic fund?
So whenever a fund house or anybody who's position you a sectoral or thematic fund, first of all, there has to be gap difference between sectoral and thematic fund. But let's, for the argument's sake, keep it the same. The moment someone tells you that a fund house comes and tell you that we are very positive on a particular sector, for instance, we are very positive on defense sector or power sector or any particular sector. A simple thing to be asked from the fund house, if you are so convinced about, let's say, defense sector, then how much overweight your existing scheme carry in those particular themes or particular sector? That will tell you a full story. For instance, if somebody tells you that we are very bullish on power sector, we are very bullish on digital sector, then ask them in your existing mutual fund scheme, be it large cap, flexi cap, mid cap, small cap, or whatever you call it, how much is the weightage of that particular sector? For instance, if defense weightage is at 2%, then does your portfolio manager own 5%, 6%, 10% in the portfolio? Is he ever overweight, and how much overweight? If you don't get that answer, then it is very clear that is asset gathering exercise rather than a deep conviction idea which has been communicated to the investor.
The other aspect that I wanted to talk about with you is the new fund offers. And a lot of people, and this is, I guess, to a certain extent, the fault of the advertisers also, because you talk about that 10 rupee NAV, the net asset value, which is essentially the cost per unit. And a lot of people get drawn into it thinking that they are able to pick up something at a discount. And I've tried, Vijay, to compare this with an auto manufacturer, a car manufacturer. When you go to the showroom, the salesperson will always show you the newest car. You can, of course, buy something at an attractive entry price, but that is not the case for a mutual fund unit, where a mutual fund is a manufacturer of financial products, but ultimately what they're buying is a State Bank of India, is an ICICI Bank, and just because you have an NFO, you're not going to get that at a discount.
You are absolutely right, Alex, and it is just not the question of the car analogy. Actually, in mutual fund is much worse, because once you bought a car, you can't change the car. But as far as new car is concerned, they come with new features. But something, in mutual fund, existing scheme can have same kind of stock. So if you are looking at buying an NFO, don't buy just because it is available at 10 rupees. 10 rupees NAV just reflect the value of underlying portfolio. Suppose your fund, which is at 10 rupees NAV or 100 rupees NAV or 1000 rupees NAV. And suppose you invest in all 3 funds, and all 3 funds increases their value, say their NAV growth after 1 year is 20%. So 10 rupees NAV fund will become 12 rupees after 1 year. 100 rupees fund will become 120, 1000 rupees NAV fund will become 1200 rupees. So it is not that the 10 rupees fund will add 200 rupees to the value, not at all. If all three funds are run identical, then the growth in all three funds will come identical. So valuation growth, portfolio growth will happen similarly. So suppose you invested 1 lakh rupees in a 10 rupees NAV fund, 1 lakh rupees in 100 rupees NAV fund, 1 lakh rupees in 1,000 NAV fund, and all these funds, for argument's sake, say they generate 20% return over the next 1 year. Then what happens? Your 1 lakh in all three categories, the NAV 10 to 12, 100 to 120, 1,000 to 1,200 rupees. But as far as your portfolio is concerned, your 1 lakh has become 1,20,000 in all three cases. So since it is available at 10 rupees NAV, have absolutely no meaning. Don't buy NFO just because it is available at 10 rupees NAV.
And very well put. Thanks so much for clarifying that. There's one more aspect, and I found it very interesting when we were talking about what we could speak about today, Vijay. You mentioned that before you invest in the NFO, if you are to invest in an NFO of in an equity mutual fund, you should look at the balanced advantage fund of that same fund house. Why is that?
So I found very interesting when you listen to a fund manager or the team and when you ask them what is the allocation in balanced advantage fund, because that is a fund in which the fund manager have a discretion to move equity up and down based on what they believe is the right valuation and where they're going to make more money or where there's a possibility of capital protection. If in the opinion of fund manager, the valuation is stretched, then they normally have a lower allocation of equity in balanced advantage fund and they see great opportunity in the market, they naturally increase allocation in balanced advantage fund. But I found sometime very ironical or very funny is that a fund house have a lower and lower allocation in balanced advantage fund and continue to come out with NFOs. So there is something amiss in the whole process. If why you're raising money in NFO? Because you believe that you could invest investors' money and generate return. If that is the case, then why you haven't completely exhausted the upper equity limit which you set yourself? So your balanced advantage fund can go up to 80% in equity. Right now it is in 30% in equity. And then you're coming with NFO. So I found little challenging. So again, it shows that perhaps it is more of a asset gathering exercise than anything else.
Yeah, you couldn't have said it better, Vijay. Thanks so much for joining in, for giving us the perspective that you did. I think that this can be a primer to anybody that is looking to invest in the mutual fund space. All right, and that brings us to the end of this particular edition of the Mutual Fund Show. We weren't able to take any questions today, but we normally do. So don't forget to send us questions on the WhatsApp number that has been playing at the bottom of your screen. Do stay tuned. Lots more coming up on NDTV Profit.